on.
Yep. All right, guys. Welcome to another week of the Educated Homebuyer Live. It's Wednesday. It's 5 p.m. It's time for Josh and I to answer your mortgage and real estate related questions to help you guys become the educated homebuyer. So, Josh, since last Wednesday, absolutely nothing has changed in the market. We're essentially sitting in the same exact place as we were back then. For the most part, we saw a little bit of improvement towards the end of the week, given a little bit of it back, but I don't think we're going to see much of a change overall in the dynamics, the rates. So with that, what do you have to offer the listeners this week?
It's Wing Wednesday. Where are you going to get your wings tonight?
You know, I'm not going to Wing Nuts because sadly they are out of business. You know how many people I've met that I never knew went there? And we
the
all
best
have the same
wings
conversation?
ever and the worst management. All it took was someone with a pulse and an IQ of 92, and they would still be in business because those wings were so good.
Agreed. If you're listening to this, there is an opportunity in the market to open a good wing place, like a Wing Nuts. Just still the concept. Do the same thing. It's really simple, guys. Anyway, that's not why you're here. You're here to talk real estate. You're here to talk mortgage. But before we do that, as we always do, we're going to look at some charts. While we're doing that, if you do have questions, I would ask that you start putting them in the comments now so that we can address those. Kevin's already here. Kevin's here.
I was about to say my feelings are hurt. Kevin has not introduced himself, and Willing hasn't asked 4 crazy questions yet. So I was like, what is going on?
Yeah. So we have 2 of our regulars already in the chat. Actually 3 at the moment. So let's get into some charts and then get into some questions and go from there. So Josh, let's pull up those charts and start looking. You're delayed, bro. You're delayed. You took them out of the thing.
My finger was not on the trigger. That
Not
Pearl
on the
Jam
pulse.
concert took it out of me last night. I'm a little not up to speed.
We'll let you tell the viewers about that in a bit. So we always start with inventory. This week, 578,000 single-family homes are unsold on the market. It's up 1.7 from last week and 36% more than a year ago. But here's the thing. So this all comes from Mike Simonson, who Altos Research, Housing Wire bought Altos. So these are his comments. I just read them. He does it better than I can say. So with that, he says, like price cuts, inventory growth is localized, much more in the South than in the Northeast. As of this week, every state in the country has more inventory than last year. Nevada and New York just flipped positive this week. Inventory growth is everywhere. So that is a positive thing to see. If you notice this chart, we're missing Orange County and Huntington Beach data. What happened? We put it on its own little chart here because we have our own data that we've been aggregating over the last year or so. So Orange County currently sitting at 2,573 homes. Huntington Beach, 145. So down in the bottom right, you'll see week over week, Orange County increased 2.57%. Huntington Beach is actually down 4.14% week over week. So we're going to do these every week. You're going to be able to keep track of those markets. If you're here local, if you're anywhere else, I apologize. The best we can do is give you this from Calculated Risk. So Calculated Risk comes out with his housing reports. He typically does it 3 to 4 times a month. It's always from the month prior because that's how long it takes to get the data. It's about a month old. But the 4th reading or the 4th report from April for new listings essentially showed most markets are still down from 2019 levels, with really the only exception here still being Jacksonville, up 26.2% from 2019, up 55.6% year over year. So I like to pay attention to those last 2 columns. Year over year is important. More importantly, how did we look prior to the pandemic? Because that was a more normal market. And as you can see, on an average, we're still down. Weekly change, we went from 568,471 to 578,016. We now have the new peak in inventory, which came in 2024, now sitting at 578,000 homes. So very, very important to note. That'll take us into the new listings data. So new listings, volume. Mike seems to think that volume is peaked for this year. Unfortunately, the April end timing is not unusual, but I was hoping for a few more weeks for seller growth. He says 68,000 new listings unsold. That's up 13% year over 13% year over year. Plus, there was another 16,000 that already went into contract. So in total, 5% more than the same week back in 2023. This takes us into the calculated risk showing active inventory. Actually, did I put active inventory in here twice, Josh? Oh, the new listings data should have been the one that I'm talking now. So these are reversed. So
Jeb,
my
I'm glad
bad.
that you go. Hold on, though. Go back to that because one thing that doesn't make sense to me, just with my limited knowledge of Florida, that's Jacksonville, the Southwest Florida, the stuff on the Gulf, the stuff that got destroyed in the hurricane is where we're having the most issues. Jacksonville is newer relative to parts of Southwest Florida or South Florida, and especially Southwest Florida. That's kind of interesting to me that they're having some of the same issues.
But yeah, and I think they encompass Jacksonville. I think they probably throw Tampa in there, like some areas that are right around Jacksonville. They're kind of the same market, would be my guess. Is it's kind of all kind of thrown
Tampa's
in that.
on the other side of the state.
Is it?
Jacksonville is up.
No,
You're from North Carolina. Jacksonville is almost in North Carolina.
I thought Tampa was near Jacksonville. Is it not?
No, Tampa's
Orlando's near Jacksonville.
Okay,
Something's near Jacksonville.
Disneyland's
I don't know.
somewhere near Jacksonville.
Yeah, I have no idea. There we go. Anyway, just disregard.
You can tell Jeb's from North Carolina, but doesn't pay attention to anything around.
We didn't go down there, dude.
Him.
Those
you didn't go to Daytona for spring break, MTV
no,
spring break 86?
We weren't allowed to. We went to Cancun.
Oh,
yeah. Right. Anyway, so active inventory should have been the first chart I showed. New listing should have been this one. So you can kind of reverse, look at them. So you can see active inventory is still down 26.4% on average compared to 2019, but still up 31.7% year over year. So inventory is increasing, still down from a more normal time in the market, which is going to take us into median home price. So the median home price of all homes on the market right now, $450,000. That's unchanged from a year ago and 2 years ago. June 2022 was the absolute peak for home prices in this cycle as of right now. Weekly.
Per the horrible metric that is median home
Agreed.
price.
Agreed. Weekly total home sales pending, new contracts pending this week, 68,000, down 6% for the week and unchanged from the same week last year. And then that's going to take us into price cuts. So price cuts, 34.4% of the market has taken a price cut from original list price. That doesn't mean prices are down 34%. It just means if my price was $500,000 and I lowered it to $499,900, a drop of $100, that now registers as a price cut. So 1/3 of the homes on the market, just over 1/3, have some sort of price reduction. That said, Josh, that's going to push us into looking at year over year changes in CPI.
So we talked about pretty boring week in mortgages and finance. Our friend Matt Graham basically called it an 11-day weekend because no data, nothing really happening in the financial market. So let's go back. Something that we had talked about last week, 2 categories accounted for all of the growth in CPI-based inflation, and it's car insurance and shelter costs. So this is funny, Jeb. Did I send you the link to the?
It ain't funny, bro. My car insurance is stupid. It ain't funny.
Yeah, I'm not talking about that being funny. I'm talking about the stupidity of people on Twitter being funny. A gentleman posted this chart, and he said, "Remind me again why higher for longer." And the point was shelter costs and car insurance costs are not impacted by anything that the Fed does. So when we look at the gray, that is other, we are well below the 2% target. So the things they can control are back under target. 2 things they can't are massively outsized. But it started a basically troll war. And what I realized, Jeb, reading some of these comments is that I was dumber for having read them. But people think that Fed policy is to achieve wanted outcomes, not truly the 2 mandates, full employment and price control as defined by PCE inflation at 2%. But people saying, well, they have to keep home prices under control. That's not part of the mandate. It may be something that everyone wants, but it's not part of what they do, and it's not something they can control. The Fed putting their thumb on the scale is what got prices here. The Fed putting their thumb on the other side isn't going to fix it. So hate to share that news with anyone, but it will be interesting to
You're a liar, Josh.
You're a liar. Trumper. Anyways, this is another look at it here. The blue line CPI year over year, the red line owner equivalent rents year over year. So we just saw how much that measurement of owner equivalent rents is impacting and keeping CPI elevated. It's coming down, and I hope I put these in the right order here. Jeb, this here is an interesting divergence.
I'm going to stop you 1 second. Make sure you have tabs closed because you went out on me on this side. So make sure you're not pulling anything
closed
unnecessarily on that side, Josh. Make sure your internet is full capacity.
It's the joy of Frontier talking about their 14 terabyte download speeds and then actually giving you 56K speeds when you're not looking. For you kids at home don't know what 56K modem or 28.8 modems, better yet, they were fun little things that used to squeak and make pages load in 14 minutes. So this here, Jeb, is from CoreLogic and just showing a divergence in rents for single family attached versus detached. So if you're in an apartment attached to other people, rents are getting cheaper. If you're wanting a single family home, rents are not really getting cheaper. Definitely down. Rent increases are down from those big spikes, but we're actually seeing decreases in attached units while we're still here, 3.5%, 4% year over year increases for single family homes, and not likely to change anytime soon because we're not building enough homes. Just like it's hard to find homes to buy, hard to find homes to rent. So home prices and home rents are both high. Fannie Mae came out with their economic forecast, Jeb. Not that their economists are any better than anyone else's economists, but they're professional economists that are trained and paid to follow this stuff. So some interesting things here. They have their projection for core PCE throughout 2024 being at 2.7, 2.8, 2.8, dropping next year to 2.5, 2.3, 2.2, 2.2. So really still, they think at the end of 2025 above that 2.0%. But then you look at GDP and they see GDP weakening to 1.8 in the third quarter, 1.5 in the fourth quarter, but then magically picking up again somewhere to 2%. If the economy slows that much, I have a hard time believing that inflation isn't going to moderate more than this. So we may not see the economy cool more than what they're expecting or as much as what they're expecting, but I have a hard time squaring the two of those. And the most interesting one is they see core PCE moderating down to 2.2%, but they see no movement in the 10-year treasury between now and the end of 2025. 4.6, 4.7, 4.6, 4.6, 4.6, 4.6. So what that tells me, Jeb, is they have given up on forecasting. They just said it's going to be whatever it is today.
Yeah, sure. I mean, our forecasts and their forecasts are about as equal. They're in the same ballpark, and we don't get paid for them.
Forecasts are like,
opinions.
So this is an interesting look here. This is using Fred data. Someone went through and basically said median weekly nominal earnings. So gas. The all formulation gas price divided by median weekly nominal earnings. So people freak out. They go to the pump and they go, "Oh my God, you guys around the rest of the country, what are you talking about? Gas is not $5 a gallon." In the communist state of California, we have $5 a gallon gas. So for those of you who are in California, you pull in and see your $5 a gallon gas. It is very high, but as a percentage of wages, it's not low, but it's not historically high. We've had several periods where it was much higher than this. So we'll see where it goes from here. Jeb, we talked about last week, we had retail sales strong. And this is another look, another chart saying retail sales still strong. I added that dashed line there so you could see pre-COVID and then post-COVID, we're kind of back to what normal is. But pre-COVID, we had 2% inflation. Now we have 4% inflation, depending on whose measure you use. So this is still not strong retail sales. It's dollar amount retail sales being held up or propped up by inflation in prices. But we saw, Jeb, I don't know if you saw this week, Target, what did they, 5,000 products? They're going to roll back prices, trying to compete with Walmart. Walmart said they're not raising prices. They're holding the line. Costco, same thing. So only time will tell, but we are seeing improvement. Jeb, this is the sad chart that last week we were very happy to point out that we had broken out the bottom of our little channel, our angry red channel of rising interest rates, and we are back in it now. So we're at the bottom, pushing along the bottom. We need a firm and definitive breakout before anyone can say that we're out of the woods and we're not going to see higher interest rates.
So you're saying we haven't peaked yet?
I'm saying there's a possibility.
See, I have us out. I have us out of the thing, but that's
It could be the difference between Heikinashi and your normal candlesticks.
Yep.
But in the real world, what does that equate to? 30-year fixed, 7.09. For the really well-qualified borrowers, we have a listener to the show purchased this week, 6.875 with 20% down, 800 credit score. So could be better than this, but plus or minus 7%. And FHA stuff, FHA is going to be way better than this, 6.64. We've been looking at most people with 640 plus credit scores in the 6.375 range. But your mileage may vary depending on your qualifications and who you are working with.
Awesome, Josh. Can you put us back to our normal? There we go. So with that, guys, 1530. One thing we didn't put any charts in there is, you sent me some information this week from one of the newsletters that you subscribe to, just showing how rents are exceeding wage growth. And in some of the areas of the country, it's substantial. Florida, parts of Florida was one of them. Was it Jacksonville? It was one of those markets. It was like
maybe Tampa. They're right
Tampa.
next to each other.
Tampa. Hey, it was actually Tampa. They might. Hell, I don't know Florida. I just know what's at the southern tip of Florida. That said, I threw some information in school, our community, which is linked below, that kind of goes over that. It's a really interesting data. There's some really interesting charts in there. If you're interested in additional stuff that we don't talk about here that is affecting the economy, affecting the market, affects you, your pocketbook, all of that stuff, subscribe to the community. It's $5 a month. It's really cheap, and you get access to us. In fact, Josh, we're teetering on the idea of doing our additional live as part of that community versus StreamYard. So just so you know, that's in the works. We'll see if it comes to light or not, but that's where we're headed at the moment. So anyway,
dangling the carrot to get
it's out there.
Join our lovely community.
That is correct, and help support the cause here. But another way you can support the cause, hitting thumbs up, subscribing to the channel if you're interested. This past week, Josh, what did we talk about on the podcast? We talked about
interest rates.
Locking your rate. We get a lot of questions, guys, on rate locks. When should you lock? How do you lock? Why should you lock? Should I lock now? Should I lock later? What costs are involved? All of those. We answer them in a 30-plus minute episode. That's all we talk about. It's rate locks. It's on the Educated Homebuyer channel. Check it out if you haven't done so already. Listen to it on Spotify. If you've listened and you liked, give us a review. That helps. It helps support us, helps push it out to more people. That's the last I'll say about it. And lastly, if you want to work with Josh, myself, our team here, you can do so by hitting that referral link below or going to that website. So Josh, we've gotten all of that out of the way. Let's talk
just briefly. Hold your thought on that referral. Had a listener reach out today, and I think it was actually someone who watched your videos. They're not a regular listener to the podcast.
What?
Not a regular listener to the podcast. Disgusting. Every red flag we talk about of working with a lender that is not working in your best interest, told them they were pre-approved for a conventional loan. They get a house under contract. They get a loan estimate for an FHA loan. The FHA loan is not locked. They ask, why is it not locked? Oh, don't worry about it. Rates are going to get better. Okay, cool. And then don't worry, just sign the loan estimate. Those are just a rough estimate. We'll work those down later. A bunch of points in box A. It was an interesting box A because there was nothing else. They had an empty box A except for the discount points. So it's just the biggest problem or issue with that is they're all the way into contract. They've been feeling like, hey, this person's not really answering my questions. And now it makes it harder. Just for a limited amount of time, they feel committed. They're in the process. They've received the disclosures. And I tell you, regularly, we talk to people and we go, hey, this isn't the best deal. We can do this. And they feel compelled to finish that process because there's only 3 weeks left, or this person's already done this amount of work. If you start getting feelings that the person isn't giving you the answer to your question or is avoiding the questions, talking around it, don't get sold something. Reach out to us or someone else and get a second opinion and see if you can get the feel you're looking for when you're talking to someone.
All right, good stuff. So here's a question actually on rates. Wife and I are building a house and are closing September, October. I'm receiving $21,000. I'm receiving $21,000 in builder incentives. I was going to use a good chunk of that to buy down my interest rate. Hold on. Let's see here. There we go. Thoughts on that? If rates remain high, should I use that money on upgrades instead and refinance when rates come down, or stay with buying my rate down? So, Josh, what are your thoughts? We've answered this question in many ways, many different times. Has your theology changed?
No, other than there is not a right answer. There is a right answer for you. We talked about the context of this. Had a client a few weeks ago, makes a lot of money relative to his purchase price. So low debt to income ratio. It's not going to make a difference one way or the other. He felt none of us know for a fact that interest rates are going lower, but he felt fairly strongly that the next year or two, he's going to be able to refinance and he will not have a problem making the payment between now and then. So he made the decision, I'm not buying anything down. I'm going to watch this and wait and hopefully roll down in the future. Now, if you have a 47.8 DTI and you're not comfortable with that monthly payment and you can get it significantly lower by using that, it can be a valid and justifiable decision to do a temporary or a permanent buy down. For me personally, my gut says use it for closing costs, have no sunk costs in that loan, and be positioned to refinance when the time comes.
There you go. We don't have any comments, so any questions. So I'm just going to post comments on here. Matthew says, smash the like. I like that comment, so I'm going to post it. Drew basically tells me I'm an idiot for thinking that Florida, Jacksonville, and Tampa were near each other. And he's right. He has every reason to think that. Tampa and yeah, that's right. No, Tampa and what am I thinking about? Orlando and Tampa are near each other. The others are not. Jacksonville's nowhere. No, Jacksonville and Orlando.
Jesus,
there we go.
Stop talking about Florida.
I'm confusing you people.
You're confusing everyone.
Hey, I'm confusing myself over here. Anyway, he thinks I'm an idiot, and I agree with him. ZL asks, have you ever fired someone for having unrealistic expectations and was wasting your time? Yes. I've been reading how people expect the realtor to do whatever they want with no question. So, yes, no. I mean, the beauty of being in this business for any period of time, well, not for any period of time, for an extended period of time is hopefully you have more than one client that you're working with, and you have the ability to say no to unrealistic people. People that only have one client, people that don't do a lot of business, don't have the benefit of telling people to the luxury to screw off in some cases. So yeah, there are unrealistic people. There are people that you have a conversation with before you ever decide to work with someone on either side and realize it's just not a good fit. It happens. It's like any business. It's normal. You're not going to work well with everyone. Personality just don't mesh. It's all good. Yeah. But yeah, I'm sure Josh has had many in a similar scenario.
There are just people that are difficult to deal with. And, we had one 5-6 weeks ago and just got to the point where Jeff said, I can't hear you complain about that person anymore. You need to get rid of them or shut your mouth. One of the two.
That's normal for me to do. Hey, Josh, either or get off the pot, right? It's, hey, make a decision here, buddy. Can't have it both. We got a first-time listener. So OK DJ. An OK DJ. I mean,
is it just an average DJ or is it a DJ from Oklahoma?
I think it's just an average DJ.
I was hoping that we were
maybe this
Oklahoma.
Is Dustin Johnson. Maybe he's OK DJ.
Because he went to live. He's not great anymore. He's not great DJ. He's just
exactly.
OK DJ.
He's mediocre DJ. His wife, on the other hand, is a step above mediocre. Just so
I don't think your wife, if she watched,
my wife knows. My wife is cool with that.
Okay,
my wife would agree with that. In fact, user 007 says for Josh to trigger him, talk about PPP loan forgiveness and student loan forgiveness. Do they anger you equally? Why or why not? So, Josh, what do you think about student loan forgiveness?
So
no, I'm being joking. We're not going down that rabbit hole. I'm not even letting you answer that. We're moving along.
Okay. I wasn't getting upset.
Marissa Rain says, how much does it usually cost to buy down your rate? So Josh, I've heard you answer this. I could answer it, but because you're the expert here, I'm going to throw it your way.
Give it a shot. You've heard it 1,000 times.
1%. 1%
get you how much, Jeff?
A 0.25%. 0.25%
in interest rate.
So if you had a $500,000 loan, if you had a $500,000 loan 1% is 1% of the purchase price. So that's $5,000 would get you 0.25% lower on the interest rate. Typically speaking, sometimes a little bit less, sometimes maybe a bit more. Just really depends on the market at that time.
And recently, we say the rate change has been a little bit abnormal in that lenders are trying to give you incentive to pay those points and buy the rate down. They want you to have a lower interest rate and some skin in the game so that you're less likely to refinance and take that loan away from them in the short run.
There you go. We've got Kim coming in asking, here in OC, home prices are going for $1 million or more. What is the top 3 affordable places outside of Orange County? So we have to take affordable.
Fresno, Visalia, Tulare. There's 3 places.
Yeah, but when we say affordable, what are we talking about? If it's $1 million here, is $800,000 affordable to you? Because if that's the case, then you can find homes in Corona. You can find homes in Riverside. You can find homes in other areas. But if affordable is $350,000, $400,000, closer to the national median home price, then you got to go to the areas that Josh mentioned. You got to go to Central California to be able to get anything near those prices here locally. And that's not even, I wouldn't consider that local. That's 3.5 hours from here, with no traffic. So, if you want to clarify, Kim, we can talk a little bit more about areas, but again, we're guessing to some degree. Clip Some Easy. This is a long time viewer here that hasn't been on here, in quite some time. At least
maybe he's been, he just hasn't been asking questions.
One of the original supporter, quote unquote supporters of the channel back in the day. So thank you for being here. Do you know why Canada does not offer fixed mortgages? I believe they only offer adjustable rate mortgages, which adjust every couple of years. Any idea why they go that route? Beneficial, etc. So Josh, do you know why we're the only country that really offers long-term fixed rate mortgages?
No, but I will hazard a guess. All of ours are essentially guaranteed by the government. So Fannie, Freddie, FHA, VA, USDA, there is some type of government guarantee that incentivizes banks to lend on the long-term 30-year fixed rate. It's an anomaly around the globe. There are a handful of other countries, but most places either have purely adjustable or fixed for a term and become adjustable, or fixed for a term and have to be refinanced. So don't have a real great answer for you on that.
All right. Let's see here. Desonic J 5672. I love how people come up with their names. Like, what is the 5672? What do we think that is, Josh? Where would you come up with 5672?
5672.
Was that like you wanted that in Gmail and that's the one they referenced you? So you just said, that's going to be my nickname.
That's me.
I don't know. I'm not picking. I'm just asking.
Maybe I use the D and the J. Maybe it's Dustin Johnson's brother, Sonic DJ 5672.
I see where you're going with this. Or maybe DJ got pissed off and came back on as his other one, Yeah. Anyway, just went into escrow in Redondo Beach. Should I lock or float into this or next week? So Josh, we talked last Wednesday with essentially 11 days of no data. Right now, we still, I don't know, have a good 4 to 5 days at least. PCE comes out next week. Or this
next
week?
Friday, and then we get something. GDP earlier in the week, but it's not generally a huge market mover. But those are the big ones for next week. So even those are not big, huge market movers until.
So, what are your thoughts on this question?
Here, I have a lot of clients floating right now, like 5 or 6 loans that are not locked. I'm not nervous about it because I don't think anything's going to happen in the near term future. Some of them had like 40, 45 day escrows, and we're just biding our time to get inside of 30 days. You get a little bit of improvement there. So if we think we're going sideways and then we can get inside of 30 days, probably going to lock it. So this is the thing I tell everyone is when we get to the end of the 11-day weekend and data comes, are you willing to float into that data, or are you going to lock going into the data? If you're going to lock going into the data, just lock now and take the stress and risk off the table. If you think you're willing to float into that, or you want to think on it a little bit more to determine whether you're willing to float into that data, then by all means, I don't think there's a lot of risk. We've seen that chart. We're going to go sideways in a very narrow range between now and the next sets of data. And that next set of data being PCE, then followed the following week by non-farm payrolls. is probably going to dictate, do we make a run to the top of that channel, or do we finally truly break out of the bottom of that channel and see better interest rates?
All right. Dustin Johnson's alter ego basically came out and said it's his troll account.
Why do we only get the troll account? We don't get the real account?
Because it's Dustin Johnson. He doesn't want us to know he's really on there. Trying for
he doesn't want you sending messages to ask for his wife's autograph picture. Yeah.
Paulina, we're here. We would love a sponsorship. ZL believes the 5672 is his PIN to his bank account. I think that's probably, fairly accurate. Let's see here. Jonathan, in all seriousness, says, why aren't 111 buy downs offered? Or is it just my lender? Similar account and escrow needed a 2-1 buy down, but would give more time. So, I guess explain, John. I mean, the 3-2-1 or the 2-1 offers you a greater benefit up front. So essentially what you're looking for in a 1-1-1 is just a temporary buy down for 3 years in that case. But does anyone do that, Josh?
I've seen a few advertising a 1-1 buy down. So you get 2 years of the one. I don't know that I've seen anyone with a 1-1-1. If they're willing to do any type of buy down, they should be willing. They're willing to do a buy down, they should be willing to cooperate. It may just be software programming in their system, because they're just setting up this offset account for the money to go into to subsidize that payment for 24, 36 months. Don't have a great answer for that, but I have seen a 1-1 advertised from an investor.
All right. I wanted to touch on this before user 007 leaves. Is PPP loan versus student such a controversial? No, it's not a controversial topic. I just didn't want Josh to go off on a tangent, and I wanted to answer questions. That's all it was. But
I'm very focused, Jeb. I only answer questions.
I mean, PPP loan forgiveness is what it is. I mean, that was free money. Like no need to get upset about that. That was, that was the
purpose of the program. It says, hey, here's a loan so that you don't lay people off. And if you don't lay people off, we're going to forgive it.
Absolutely. And did people take advantage of it? Absolutely. Did it add probably $1 trillion or so to the national deficit? Absolutely. Was it necessary? Absolutely, to some degree, right? It was needed at that time. We can always look back on it and say we should have done things differently, but quite frankly, the government jumped in, did what they needed to do at that time. And it was the right move at that time. Did they take it too long? Did it last too long? Probably.
The other one was the boondoggle, the one that came after that they just shut off like 6 months ago, and we're still giving out money to giant corporations that didn't need money. Most recipients of the PPP were small businesses. Who cares? You helped them at a time when they needed to be keeping people on payroll.
Absolutely. And then the student loan forgiveness, you pick your side on that. I don't necessarily agree with it, but I've got a lot of friends. Josh has got clients that benefited from it. So, hey, if you're one of those people, fantastic for you. I just,
well, there's things. Jeb, there's times when,
yeah, go ahead. We're going to say the same thing.
There's two different pieces to it, though. There's Biden just saying, hey, you have student loans, I want to forgive them. And then there is the public servant loan forgiveness. Or if you give 10 years of your life to something that is suboptimal income wise. I have a set of borrowers we've done 3 or 4 loans for, husband and wife. And she had far more student loans than he did. They're both attorneys. And she had to go work for the government because it made more sense to do that for 10 years. So the government got a really smart, high-performing attorney at a discount for 10 years, and she gets her student loans forgiven. That's a trade-off. Like, if you go and borrow money, we don't just go, hey, cool, you borrowed it. We don't think you should pay it back. Like, I just don't, it's not fair to the people that didn't borrow. It's not fair to the people that are paying theirs back, who have paid theirs back. There's just better ways of going about it.
All right. And Dustin Johnson came back in and said he basically thinks I'm an idiot too, because I'm using my real name on the internet.
Let's see if we can get 3 idiot calls for you.
I mean, that's, I don't disagree with any of this. It's all very, accurate assumptions. There's a couple of questions here. One I have for Marcus. He says, in my area, starter homes are selling $90,000 over the asking. How is it in your area? What area are you talking about? And what are you referring to as starter homes? I would love to know where you're located and what price you're talking about. Starter homes in our area, unfortunately, at this point, are probably close to $1 million. I mean, if you're talking single family homes, the median home price where we're located here in Huntington Beach, or just say Orange County, is about 1.2 million. That 1.2 million in Huntington Beach gets you a 1,200 square foot single level home, 3-bedroom, 2-bath on maybe even sometimes a 4-2, same square footage, on a 6,000 square foot lot. So is that affordable? I don't think so. But that's what it is. It is what it is at the moment. So that's where we are.
The two hottest market, Jebs, are Jeb.
There's two of us.
Jebs are California and the Northeast. We help people in both places. I haven't seen anything go 90,000 over. Seen a lot of stuff 10, 15, 20, 40.
I mean, I just sold one 100,000 over on 2 months. We listed at $1,350,000.
Okay, well over $1 million, right? So still less than 10%. Like much over. We're seeing things going as much as 10% over asking. If it's a desirable, well-priced property. The people in Pennsylvania, they're listeners of the show, they, I think what they're buying was listed for $545 and they paid $601. And then they listed their condo, they listed for $350 and they got $390. So, the only people that it's hurting are those trying to step on the property ladder. Those that own and are moving up, it's not such a big deal.
Agreed. Acacia says, I'm so nervous for the underwriting process. The reason this is in here is because you shouldn't be nervous for the underwriting process, assuming your mortgage professional has done their job correctly. If there's reason for nerves, I mean, maybe your loan officer said, hey, listen, this is tight. It may or may, then I get it. You should, maybe there is a little bit of nervousness there, but assuming you're a well-qualified buyer, and your loan officer has done what they're supposed to do, you shouldn't be having any nerve issues. Josh, this is a question here around something that we kind of talked about today a little bit on our podcast. We talked about refinancing, cash out refinancing specifically. It's going to drop in 2 weeks because we're actually a little bit ahead of schedule. But anyway, Caesar says, how do we contact you? So there's actually a referral link scrolling the bottom. If you just go to that link, type in your information, you'll get in touch with us. I want to reach out and weigh my options. Have a 2.25% on $140,000 loan with 15 years remaining. Loan 15-year. $140,000 left on a 15-year loan. Sorry. House is worth about $380 and want to pull out equity. Want to see if you should refinance or HELOC or do a home equity line of credit. So Josh, when you see this question, what's the first question you ask them? How much they're pulling out?
1,000%. If we want to go blended rate, what's the blended rate? Let's say that, that you want to go to 80%. So 380, you're talking, a $300,000 loan total. So we're talking 160 on top of the 140. If that's at 9%, somewhere ballpark in that at an 80% cash out, it's going to be somewhere in that 9.5% range.
Ouch.
So when you look at that and blend it out, now you got half of it at 2.25, half of it at 9. So what does that give us? 5.5%, 6% blended. Still probably says second mortgage, but some people would say, I prefer simplicity. I just want one mortgage. Some people would say, hey, 140,000 of it on a 15-year. I'm not comfortable with that going to 80%. Now, if you say I want $50,000 and you owe 140 at 2.25, then that's a no-brainer. That's absolutely a second mortgage. So some of it comes down to your comfort level, risk tolerance, how much simplicity you want in your life versus being willing to tolerate a first and a second mortgage.
All right, good stuff. Here's a good question. Real Estate Curious says, have a Florida condo worth $380. Mortgage balance of $160. Should I prepay my mortgage or save more? They go on to say that they're 60 years old and have about $615,000 in retirement assets. So Josh, at 60, would you prepay your mortgage with having roughly $200 and just over $200,000 in equity on that property?
No, and there's another piece here that goes somewhat unsaid. 60 is generally prime earning years. the last 5, 10, 15 years of your career are generally your highest earning years. It's the time when you can use what little tax deductions, tax benefits you can get at a 160 loan amount. Maybe it doesn't even pay to itemize. So if you're not itemizing, that doesn't come into play. What return are you getting on your money? I'm assuming that you probably took this out during COVID. It's 3% interest rate, 3.5%, 4% at that. There's no world in which I'm prepaying that. I want to grow the 615 much more than I want to pay off the 160. If you head into retirement and you go, hey, the day I retire, I want that done, cool. But if you're earning, saving, investing, keep maxing the investment. And then, Jeff, there we go. 82%.
Yeah. I mean, if you got your, there you go.
82% jets.
So if you got that 615 invested where you're making more than your interest rate, which I have to expect that you are in this environment, your mortgage is basically free. You know what I mean? It's like, why would you pay that thing off unless, you could do it quickly and use that money to, and, add at a higher or invest at a higher rate too. So again, depends on, how much your interest rate is there, but I agree with Josh. ZL is asking, am I the only one who skips houses for sale that are currently occupied by the owner? Is it preferred to move out to attract a better sales price? No. Typically the answer is no. If the home is in good shape, the home is, decluttered. If they take our advice and either declutter it, stage it, do that sort of thing, the homeowner can absolutely be there and it will not have any effect on the price. In some cases, it's better that the seller moves out, but most times that's not realistic because the seller would then have to rent something else. And it's a cost that they don't usually want to incur because it's impossible to say how long it's going to take to sell it and so on and so forth. So yes, you are, I'm going to guess, out of the norm by only seeing homes that are vacant, but I can't speak on everybody's behalf. But most
it would greatly limit your options if you.
Oh, absolutely. Yeah. No, I've never had a client say, I'm not going to see that property because it's occupied. So just, just experience on that side. David, another regular, says, was offered relocation to another state from California. Congratulations, David. What should I consider when trying to decide whether to pull out equity in our house or not to buy a home? Should I decide to move? So here's what I would say, and I'll give Josh the floor after that. If you're unfamiliar with the area, David, you don't know the area well, first time being there, maybe you've been there, don't really know the neighborhoods, whatever, I would almost tell you go there and rent for a period of time just to figure out the landscape, figure out to make sure you want to stay there for one, figure out the area that you want to be in before buying a home. A lot of people bought homes in areas they had never been to, never spent any time to during COVID. And I can tell you, regret wise, those people are probably at the top of the list just because weather, neighborhood change, just difference, a lot of different things. So I would tell you, take your time, make sure it's where you want to be. You can always pull out equity later. Now, is it an investment property at that time? Is it a higher interest rate? That's something you have to consider. And that's where I'm going to throw it to Josh.
It's basically everything that you said. Jeb, you and I have a mutual contact, mutual acquaintance that during all of the chaos said, I'm moving to rural Tennessee from Orange County, California. I believe they were back in Orange County before the first mortgage payment became due, and now they're a long distance landlord. So that is 100% true. Be very, very careful about buying before. I can't say it on air, dummy.
Not to put you on the spare.
Yeah, I will tell you as soon as we are not talking to hundreds of people on the internet. But yeah, literally was back in Orange County before the first mortgage payment was due. But with that, look at it, consider, run the numbers. I mean, the numbers never lie. Figure out, okay, how much money do I need to buy where I'm going? If I buy, how much is that down payment taking away from my cash flow on the rental in California? And then what does that payment look like versus renting? A lot of parts of the country, with prices where they are, you can rent something really nice for what it would cost to own. And even if you did that for 12 months to get the lay of the land, make sure you like it there, all that fun stuff. And as Jeb said, you do end up changing the dynamics of what the cash out would look like. You might take the cash out and while you are in your home now and just put it in the bank for a while you are deciding what you want to do in the new market. Lots of options. So if you want to talk it through, give me a call. We can go through it off of air and go in great more detail.
All right, guys, 45 minutes on the air. All we ask is that you hit the thumbs up, subscribe to the channel if you haven't done so. If you're listening on, you could be listening on the Educated Homebuyer podcast channel. You could be listening on Jeb Smith channel. If you're not subscribed to the other, it helps. So do that if you would. We would be grateful. And if you need Josh or myself, there's a referral link scrolling the bottom of the screen that'll get you in touch with us. We would love the opportunity to help you. We do this to provide education, but we also this is our career and we benefit from this, and we would love the opportunity to allow our expertise to stem further than just the TV or computer or phone that you're watching at the moment. So number 7 says, if one were to win the California Dream for All program, how would they approach a new construction build? Josh, is there anything there that they need to do differently that you're aware of?
I believe you have to close within 90 days. So it better be a builder that has a home ready for you. It can't be, hey, I'm putting it under contract and I got this reservation. I'm going to do it 7 or 8, 9 months from now. Don't quote me 100% on that, but my understanding is you have your funds reserved and you have 90 days to get a property under contract and closed. So if it's something that's taken 6, 12 months to build, it's not going to work for you.
There you go. Outside of that, putting in an offer, I would think, most lenders, you're preparing your offer is not going to look any different. You should have something from the state that shows that you're actually
They give you a voucher. All the
won the lottery, and then you can provide that with your offer. And anybody that's in the business should be understanding of that and be able to take it as face value, and you should be good to go. But just make sure you have professionals on both sides, and as a real estate agent, as a lender representing you, and they could explain it in a way that hopefully get you in the door. Josh, a similar question we had earlier. I mean, to some degree, would you prefer your client use $20,000 credit to take a 2-1 buy down and 2 points versus a 3-2-1 buy down, but would require an additional $2K out of pocket? Josh, would you even care?
Thank you. Frankly, this is what I say. It's not that I don't care about my clients. I absolutely care about my clients. I don't give a shit. Whatever feels right to you, I will pencil it out and show you. This is all smoke and mirrors. A 1-0 buy down, a 2-1 buy down, a 3-2-1 buy down. All you're doing is taking money, putting it over here in an account, and subsidizing the monthly payment. We had a listener to the show a year ago, October, so less than a year ago, was able to close. They wanted to do the buy down. They had the extra money. Tough market. Sellers weren't going to pay for it. He goes, well, should we do the buy down, or should we just put the money in the bank and use it to subsidize the monthly payment? And that was the decision. They put the money in the bank to subsidize the payment. So if you're saying, I don't have the extra money and I can get the seller to do it, set up whatever kind of buy down you want. A 3-2-1 buy down is incredibly expensive. Most markets around the country are still very competitive, and sellers are going to chuckle when you ask for the amount of money required to cover a 3-2-1 buy down. But to Jeb's point, I don't care. The loan is the same. The loan is the same. So whatever you feel you want to do, my job is to help you analyze those numbers and then also make you aware that 3-2-1 buy down is not going to happen. We had a buyer in Tennessee. They were out writing offer after offer after offer with a 3-2-1 buy down. And we finally said, probably that's the problem, where you're getting multiple bids. I mean, it wasn't a crazy market where they're getting 5, 10, 15 bids, but everyone had 2 or 3 people competing on it. I said, everyone else is coming in and not asking for anything from the seller, and you're coming in and asking for like a ton of money in a credit. It is much, much, much more expensive, almost double the cost of a 2-1 buy down to do that 3-2-1. So from that perspective, I think they're all somewhat silly, but if the borrower wants it, that's all that matters.
There you go. Marcus follows up to his question earlier, or to my question to him. Said he lives in Southern California. Starter homes are listed for $850, selling for $940. 3 to 4 bedrooms, 2 baths, 1,400 square foot home. So if you see more than one selling, like that, then they're all underpriced, right? One here and there, then, maybe competition, maybe whatever. But if you see multiple in an area that are all doing that, then they're all priced low, probably strategically to drive up the price on the property, would be my guess. Rarely ever would you see multiple homes selling over 90,000 consistently at a similar price, because what would happen is the next one would come on the market at the higher price. I mean, if you wanted to sell your home and we thought it was worth 850 and then we see one just closed for 940, guess what we're listing your home at? We're listing it at 940. We're not listing it at 850. And then you can't then say the 940 home sold for 90,000 over the asking. You're just saying that's what the asking price is. That is the new price now, because one doesn't always set the bar, but when you got one and then multiple come on after that at that price and or higher, then that's the price. That's what they are.
Jim, hold on. React to this, because this is people lose sight of this. In a competitive market, it is impossible to underprice a home.
Agreed.
Agreed. Because that's what it does. I mean, the market will fix it. As long as there's 3, 4, 5, 6, 7 people that will come in and bid on it, the market will fix it. You want that auction. You just like you said, you want that auction process and let the market determine the price. A realtor can absolutely set a price too high, but they can't set a price too low as long as it's a competitive market.
That said, though, I don't personally like recommending that a seller underprice their home to try to drive up the price. And the reason for that is, so let me back up. You have 3 ways to price your home. You can price it higher than what you think it is actually worth to see if you can get that price. You can price it at quote unquote fair market value. You don't really know what fair market value is, but until somebody actually makes an offer. But let's just say you price it at where other comparables in the neighborhood have sold for, maybe slightly above that, depending on the type of market. That's the other strategy. That's what I typically like to do. That is what I recommend sellers do. And the third strategy is to price it low to try to get more eyeballs on it and drive up the price. That works if multiple eyeballs want to make an offer on the property. That's the only time it works. And in a competitive market, it will typically work. You run the risk, though, of what happens if you don't get the multiple offers? What happens if nobody does come in higher? Then what? Then are you going to raise the price on the internet? Then you look like an idiot, because they went from 850, now they're pricing this thing at 940. Because why? You've got to explain yourself. If you had no buyers at 850, you're going to have them at 940 now. How does that make sense? So I think pricing it right to begin with is the right strategy. And then if and when it doesn't sell at that price, then you can adjust accordingly until you get down to a price where you can find a buyer. But it's to each his own. There are people out there that love to price them low to try to drive up the price. And in some cases it works. Other cases, you're getting the same price you would have had you priced it right to start. So Ryan says, who can afford multi-million-dollar starter homes in SoCal? Nobody, Josh. Nobody can afford these prices.
He starts by saying they're all selling, but no one can afford them.
Nobody can afford these prices, yet they seem to sell right away. Who is buying them? So question that we get all the time. Hard to speak to the entire population directly who's buying these homes in Southern California, but once a month, existing home sales report comes out. In fact, it came out today, Josh. If you want to answer, we're going to come back to this question because I'm going to answer it in the best way I can. But before that, answer this question from ZL while I pull that up, Josh, if you don't mind.
So any good guidelines to get approved by the automated underwriting system? 700 credit score here. Last year was denied by AUS. I believe it's because I had opened 2 credit cards within the last 2 months of the app. The best advice is getting with a really good loan officer that knows how to work the system as much as possible. I say as much as possible because all of the automated underwriting systems are a black box. I cannot tell you, I don't know that I've ever not got a loan approved with a 700 credit score. I don't think it's taking into account and looking granularly at opening recent credit cards had zero impact on that. There is more going on there. The debt to income ratio was above and beyond what the automated underwriting system expected. And it will never decline someone. It will decline the terms that are being put in. So if you qualify for a $500,000 house, you put in at $700,000, the debt to income goes too high, it's not going to approve you, but it didn't decline you. It didn't approve that scenario. So what we always want to do is let's work our way back down. What purchase price? So meaning what debt to income ratio will it approve? If we put in that you have $100,000 in the bank post closing, does that give us the approval? You can start to see what it doesn't like about your situation, but you shouldn't be guessing at things like this, because I could tell you straight away it certainly wasn't the 2 credit cards that you opened. There was something else there in the file, but without seeing everything, I couldn't tell you for sure. But the most important thing is that you're working with someone that knows how to use both automated underwriting systems. And I say that if we're talking conventional loans, Fannie and Freddie, they have different automated underwriting systems. Both of them can be used for FHA and VA loans, but it's the same underwriting engine underneath for FHA, the total scorecard, and the VA underwriting rules engine. So they don't really matter as much, but you want to be trying both. You want to be testing, playing at the margins, and trying to see what it's not liking about that file.
All right, so we're going back to Ryan's question. Who can afford these homes? So existing home sales report. This is from April's data. And it shows that, again, this doesn't speak to SoCal directly, but we can kind of take it as a general consensus here. First-time home buyers were responsible for 33% of the transactions in April. It's actually up 1% from March and up 4% from April of last year. So more first-time home buyers than last month, more than last year. 16% of the transactions were individual investors or second home buyers. So somebody buying, a property for an investment property, somebody buying a second home. That made 16%. So that gets us roughly 50%, 49%. The other 50% were distress sales. Sorry, that makes up a small portion, but that doesn't say who bought the distress sales. But 50% roughly unaccounted for. Move-up buyers, people buying selling a property, buying another is typically where that other 50% goes. Some of it could go a different direction. I'm not sure where else it would go. But it's people that have owned a home before, in most cases, buying something else. So you still have 1/3 of the market first-time home buyers, even with prices this crazy. Even in the market that we're in right now, the last couple of properties I've sold here locally, parents have given kids money, and not just money. Like one of them was the parents gave them $1.55 million to buy it. I had another one where their offer actually wasn't accepted, but I was representing the seller. One of the offers was a cash offer at 1.7-ish million. I mean, price was 1.7, sorry. 1.7-ish million. The cash offer was also 1.7 million. That was from a family member giving their kids money. It's crazy, right? I mean, crazy. But these are still first-time home buyers, even though the money's coming from another source. So
Jeb, I got the contract today, 1.105, and parents are co-borrowing, not giving it down. The kids had the down, but we have a co-borrower. And here's the important thing to remember. The vast majority of these homes across Southern California were purchased at much lower prices with much lower interest rates. So what we're talking about, the homes are not unaffordable. The homes coming on the market are unaffordable to many of the buyers. There are so few of them that supply and demand. We have more able demand willing to purchase those homes than we have homes available. If we had 10 times as many homes on the market, we would have a problem, because you are correct. There are less buyers out there, but there are plenty of people who can and are willing to do it. Like what I would say, Ryan actually followed up, says, I'm a professional earning 6 figures, and many of my friends are as well, and we feel totally priced out of the SoCal market. So remember, 6 figures can be $101,000, it can be $950,000. A lot of my clients that are buying in Orange County right now, it's dual incomes. Husband makes 120 grand, wife makes 135. You got $255,000. Now, neither one of those people are going, oh my God, they're killing it. But together, they have buying power. They make $20,000 a month. So a $5,000, $6,000, $7,000, $8,000 house payment is not out of the question. It's not comfortable. They're not happy about it, but they're seeing the writing on the wall that supply isn't fixing itself, and there are enough people out there wanting to buy it. So it's just, you got to take a step back and say, this is part of the reason why we're seeing gentrification. Areas that people wouldn't usually used to live in, now they're like, that's what I can afford. I want to own a home, so I'm going to make that decision. And some people look at it and they go, I'm not willing to do that. I don't want to live there. I make six figures. That's not where a six-figure person lives. So I'm going to rent a luxury apartment here because that fits my lifestyle. So a lot of it is a personal decision and just what you value.
We have a mutual friend that rents in a luxury apartment. Does very well financially, business. I mean, they make really good money. Could he afford to purchase another home? My guess is, yeah, probably. But he decides to rent and has rented for the last couple of years. What do you choose to do? I have a buddy that's worth a lot of money that a couple years ago picked up and moved to Bali. He hadn't owned real estate in 10 plus years here in Southern California, and multimillionaire, has a ton of money. And said, I just don't, for whatever reason, decided not to buy, and eventually just picked up and left and went, and he's enjoying his life for a lot less money now. Some people, just depending on where you are in your life, it's not the right move, and that's okay. You just got to know where you're going to be, how you're going to retire, and all that good stuff, right? That's where it's at.
Earn, save, invest.
Yeah,
and that saving and investing can mean buying a house, but it does not have to. We've gone through this on the show before, the other paths to it. If you are not going to own a home, if you're priced out of the market, if you're not comfortable with what you can buy, you got to get aggressive and be skilled and diligent with your saving and investing.
There you go. I'm putting this up here because this is what you want from a seller. Is someone to be realistic. But what I also want to talk about is, well, let's just read the comment. So I just put my home on the market yesterday in Sacramento for $460,000. I wanted $550,000. I'm trusting my realtor since the comps say $450,000 to $470,000. Yes, the market will decide. The reason I put this up here is because, for one, made the right move. I think pricing at $460,000 based on what you said there is the right move. But if your home is truly worth $550,000, I know that's what you wanted. But if it was worth $550,000, then the market would tell you, based on the demand that you get, the offers that you get, the competition that you see, and probably drive up the price much higher than where you're listed. So, you wanted $550,000, you took the decision of the real estate agent. Assuming the real estate agent is accurate, you're going to sell somewhere around that asking price, maybe slightly higher, depending on the competition. If they were wrong and your price was actually the right price, you're probably still going to get it, or somewhere close to it, just based on demand. I'm assuming Sacramento is still competitive, and I think that it is, just based on a couple of people I follow, but can't say for sure. Anyway, we've been on 1 hour and 1 minute, Josh. If you haven't done so, hit the thumbs up. Not a lot of questions tonight. There's people hiding. They're just listening. A lot of listeners.
They're just getting educated.
They're getting educated. Yes.
They have their notes. They have their notebook out, taking notes.
That's it. And these people are smart. That said, Josh, I think we can wrap this up. Nobody's jumping in.
So Wing Wednesday.
No, I want to. Well, you might head to Win Wednesday. I'm heading to. What is my wife was making
soccer
at the house?
Football.
I know. What was she making? I'm trying to think what was for dinner. I saw it before I left, and now I can't remember. Burgers. I'm having a burger for dinner. I mean, I'm
Burger Wednesday. Tell your wife it's not Burger Wednesday.
It is for Jeb. I get to take. Okay, so we'll just go side note here. So my son, since there's not a lot of questions, my middle son turns 10 next week, and his favorite thing to eat, more so than anything else, is a steak. And so every year for the kids' birthdays, we take them to whatever their favorite food is. And so my oldest loves sushi, so we take him to sushi. My middle guy loves steak. And so what we've done over the last couple of years is that dad takes him to steak. Even though mom loves steak, I get to take him, which is awesome. So we've always done nice steakhouses. So tomorrow night we get to go to Mastro's. So we made a reservation at Mastro's. He gets to have a Mastro steak. I think I'm probably going to ruin this kid. His taste buds
should have set him up at Sizzler.
His taste buds are going to be ruined for life. But the biggest reward here, Josh, is that I also get to benefit from this. This is like a birthday present that you give away.
You don't benefit. You get the bill at the end of the night. You're not benefiting.
No. You don't see I get to eat a great steak with my son. That's the benefit. It costs money. You can't die with it, Josh. And if we do, it all goes to them anyway. So I'm getting it, we all get to benefit from it now. Right. Last question, Gionidas. There's probably a way to say that I didn't. What's your take on seasonality? Seasonality is real. This is typically the time of the year where things start to slow down. Yes, it's the summertime. Yes, the summer is the hottest time of the year based on when most homes sell and close, but it's not the best time of the year for inventory come to the market. And so a lot of schools are getting out this week, next week, depending on where you're located in the country. We still have a month here in Huntington Beach before the kids get out. But with that, vacations, trips, camps, people doing different things, activities other than buying and selling homes takes a back seat. The market slows down. Typically, it goes like that through the remainder of the year. I don't know that this year is going to be any different unless you see a big drop in interest rates. But yes, seasonality is faux real.
Did we do a whole episode on it, Jeb?
I don't know that we did.
I think we did.
We might have talked about season. Yeah, we talked about buy, like when you should buy in the season. I do remember that. Anyway, we digress. Appreciate you guys being here. As always, appreciate the support every single week. If Josh or I can be of assistance to you, there's a referral link. Scroll in the bottom of this video. It's also in the description of the audio if you're on Spotify. If we could be of assistance, we would love that opportunity. Josh, take us out. Any final words? Give them some encouraging words.
I'm going to dispel a myth, and we're going to answer one last question. ZL follows up. Does inflation hurt realtors and loan officers? You benefit from inflation from houses. This is a horrific lie that people think is true. I would be much better off, and I believe Jeb would too, if home prices were 30% lower, because I would do 100% more transactions, literally double the amount of transactions. Folks like, was it Scott or Ryan, with $100,000 income? If the $1 million house is $700,000, he's buying.
Yeah,
we got a lot. So this does not benefit me. Is that commission marginally higher? Possibly. But Jeb, there are more agents fighting over the listings that are available. There are more loan officers fighting over the loans that are available. You're more likely to have to cut your margin because some clown who hasn't done a loan in 3 months is willing to do it for half price. So I don't think it's positive for anyone. So there is the answer. That's not the positive that we were all wanting to end on, but none of us.
I'll go out with
like inflation or appreciation. Okay, let's do it.
I'll go out with a positive and recommend a book. I listened to this book. I didn't read it.
I'm going to write it down because I forgot to write it down and I didn't remember.
Leveling Up by Ryan Leake. Fantastic book. Josh and I read a lot. Josh reads more than I do, but kids at home kind of hurt the reading to some degree. But do listen to a lot of audio, read quite a bit. I would say it's in my top 3 books in the last 5 years. It's a really good book. Leveling Up personally, professionally, just good stuff to be a better human, really. With that, be kind, work hard. We'll see you next week. Adios.
Amigos.